Good afternoon and welcome to Biztech's Asian Midday Marketwatch. Our guest today is Leung, founder and CIO of Track Record Asia. Kongi Fak Choi, V, how was your Chinese New Year?
Hey, it's good. Thanks, Brian. Kong Si Fa Chai to you too.
Now, before we get your insights, V, let's take a quick look at how crypto markets are performing, and then we'll look at regional stock markets. So Bitcoin continues to stage a comeback. It's at 42,810. It's up 3.26%. Ethereum is at 3,079.36. It's up 2.06%. Over across to regional markets, we've got the SGX, which is at 3,342.2. It's up 0.32%. The KLSC is at 1,533.50. It's up 0.71%. Shanghai is at 3,429.23. It's up 2.02%. The ASX 200 is all ordinaries is at 7,416.4. It's down 0.03%. The Nikkei is at 27,238.5. It's down 0.73%. The Hang Seng is at 24,518. It's down 0.22%. Rounding up the numbers, we've got the Kospi, which is at 2,744.89. It's down 0.2%. Now, pretty mixed markets. V, tell us why.
Well, I think the markets are now driven by essentially what's happening in the US stock markets, right? It's taking the lead from the US stock markets. Regionally, I guess China reopened today after the long Chinese New Year break. So it's slightly up on the day, so that's quite good. But essentially, it's all driven by the US stock market sentiment.
Okay, so when you talk about US stock market sentiment, I think the blowout numbers from the non-farm payrolls came as a shock to the system. So just to recap for our audience, basically the payrolls report showed an annual growth rate of hourly wages. It actually climbed 5.7%. From a previous number of 4.9%, while the payrolls for prior months were also revised upwards by 709,000. So that really, give us a sense, V, on what this impact had and why stocks rallied despite the higher rates.
Well, so I think, first of all, we got to put it in context. Last week, most of January and coming into February, stock markets were quite weak, really weak, in fact, right? And it was driven by inflation fears and higher US interest rates on the back of these inflation fears. And the stock markets sold off because of that. And US high growth tech stocks bore the brunt of this sell-off because the thought was, the narrative was that higher interest rates will affect these high growth stocks more, and then valuations too high, blah 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 blah. Then it comes off aggressively. And last week on Wednesday, we had the ADP jobs number from the US. Expectations was just a growth of about rise of 100-something thousand jobs, and instead it came down with it came to I think a loss of 300,000 jobs. And because of that, all the central banks, not the central bank, the expectations of 180,000 jobs added, and then what came out was 300,000 jobs lost in January. And this shows one thing, that all these guys churning these numbers, paid a lot of money, but they're all getting it wrong. And investment banks, all these so-called experts, they scrambled to revise their expectations. They all revised it lower because, naturally, right? The numbers shows lower. They revised it lower. Some investment banks even had, although the median expectations for the non-farm payrolls, the jobs number on Friday, which is a more important, more significant jobs number on Friday, was a growth of 125,000 jobs. Some investment banks were trying to be cute. They revised their estimates to a loss of 200,000 jobs, mainly because on Wednesday, the other jobs numbers said there's job losses, right? So the market came in very expecting weak numbers, but it came out as extremely strong, as you said. It came out to be almost 500,000 jobs added, and previous numbers were revised higher. And that shows a really strong economy. In a really strong economy, first estimates, the first estimates of economic numbers tends to be revised as more data come in, tends to be revised in a stronger direction.
Okay.
So this shows a very strong jobs market. And as a result, the US interest rates market, the bond markets, responded with higher interest rates, more than 10 basis points, which is more than 0.1% higher in the 2-year, 10 years. And that implies almost half a rate hike extra this year, right? It was already pricing for 5 rate hikes, now more than 5 rate hikes this year. And Fed has penciled in only on their projections 3 rate hikes this year. So that's a big move. And typically, if in a normal day, if you said that happens, you can ask all the experts, the bear, especially the equity bears, they'll say the stock market is going to sell off at least 2%, about 1.5 to 2%, and the tech stocks possibly 3%, even given the weak sentiment. But it did try to sell off, sold off or 1.5% on the numbers, but immediately it started to grind higher and ended the day in a positive zone. And I think that surprised a lot of bears, a lot of negative people, right? And I think the narrative is changing. Previously, we were looking at the Fed responding with high interest rate hikes because of higher inflation, and no choice because inflation is getting higher, but growth is quite tentative, right? It's still not certain that growth is very strong. It's just inflation is strong, and there's a lot of fears of stagflation, right? Of higher interest rates environment, but slower growth environment. But I think the blowout job numbers, as you called it, kind of change the narrative a bit. It's a strong number. It's a very strong number, and it also is important in that a lot of things, like you cannot trade the markets based on economic textbooks, right? If you try, you will lose a lot of money in the process because you'll be confused as to why it's moving this way, right? Like sometimes weak numbers, you see a strong response from the market. It's always the other way around. And then that's because what's missing is always market positioning, right? Market expectations, market positioning. And I think coming into this year, lots of investors have gone underinvested because it's now an obvious story, right? You expect the Fed to be hiking very aggressively going forward. Most people expect this. Most people have been talking about this. And I believe we have seen short-term capitulation on the equities front, right? Most investors, I believe now, they're underinvested or they're below benchmarks. And short-term investors are now in the camp of, trying to be nimble, trying to sell rather than trying to buy. And I think this is why the price action was a little bit strange in that sense. And I think we have seen the short-term bottom, but of course, clearly the primary driver still remains inflation. And later this week, we will be getting a consumer price index number from the US. I believe it's on Thursday, and market expects it to show a 7.3% growth year on year, higher than the previous print of 7% annualized. But we are living now in an environment we're getting used to the environment of seeing higher inflation prints. Right? But if we should see a lower than expected inflation print or a moderate inflation print, I think that's going to continue with it's going to continue to improve risk sentiment, and we're likely to have seen the bottom in the asset markets for now.
Now, on that note, CPI numbers are something that we have to look out for this week. What other key events and data points that we should watch out for as well? That could
I think there's not really much that I'm going to be paying much attention to. I think there's always data prints, right? And I think one of the tricky things about market is that some numbers matter more than others, right? Right now, I think the two categories of numbers that really matter to the US right now is inflation and jobs, right? And we are seeing very strong job growth now. And if inflation to moderate, then we will come back to the narrative of the Fed can hike, but they don't need to be aggressive, right? And with them having penciled in only three rate hikes this year, and markets already pricing for more than 5, if the narrative should change, we would see once again a big move, a recovery in high growth tech stocks, I believe. Yeah.
Now, V, as always, thank you very much for coming in, and thank you very much for your insights.
Thank you. Cheers.
Now, we've been speaking to Phan Leung, the founder and CIO of Track Record Asia, on Biztech's Asian Midday Market Watch. I'm Brian Fernandez. Check out our various platforms as well as our website, www.biztech.asia. Thank you for tuning in.